Hey everyone, and welcome to our DAT IQ weekly market update. This is our update for August 19th, 2020. I'm Ken Adamo, Chief of Analytics at DAT, joined by the owlish Ned Damon, Principal Data Scientist at DAT, and Dean Croke, our Chief Industry Analyst. Hey guys.
Howdy. Owlish. Wow. That's typically I associate owls with wisdom, but if you look up the Victorian game analogies, owls are also famous for another thing. So we'll leave that to one side for right now.
Yeah, I may not be able to wait till Christmas for my new thesaurus, so I'm running out of ideas here. So you may notice new digs. We're at the construction site here. We've had such great engagement with this video series and other things that we've done that we've decided to go ahead and do a few satellite studios around the country, with the one located in Ohio, where I'm at, to be the first. So we're really excited about it. Pardon our dust. There's going to be probably some growing pains over the next few episodes and whatnot as we get equipment shipped in and get things painted and stuff like that. But we're really excited to kind of take this to the next level. But Ned, I really hope they choose not to upgrade the talent when they're upgrading the equipment in space.
I can dance. I can learn. I can be relevant.
But anyway, so I'm going to hit us with some of the key points this week, and then I'm going to turn it over to Dean to run through our industry update. There's some really interesting stuff going on. Ned will talk about the forecast, and then we have a spicy question directly from one of our customers that we will cover later in the episode. So without further ado, I'm going to jump right into the key points of the week. COVID has proven time and time again that things can change very quickly, but this is all true as of what we're seeing right now. So rates are plateauing. We're seeing
there were signs of that last week too.
Yeah, I think what we're seeing too is when things were so volatile, you're starting to see some signs of what we would call like contribution lag. We get the vast majority of our rates come in very, very quickly, sometimes even before they're delivered. But then sometimes we see like the minority percent, 10 to 15% trickle in, and sometimes that can mess with when we're looking at stuff on an ultra short-term basis.
Yeah, no, the old minority report.
Yeah, for sure. So we're seeing load post decrease a tiny bit, load to truck ratios coming down across equipment types. We're starting to see some of that imbalance resolve itself. Especially, I was talking to a couple of reefer shippers this week, really settling into a groove with some of the packaging changes and the shift to grocery, which I'm sure Dean's going to talk about in a minute. And then when we talk about peak, we've essentially seen the retail peak date shifted almost an entire quarter forward. And dovetailing into the last bullet point, Congress largely still holds the key to what happens this fall. Do we get another round of direct payments? Does unemployment continue? Things like that will largely drive consumer spending through the fall. So without any more delay, we're going to turn it over to Dean for our market update. Dean?
Yeah, thanks, Ken. There's definitely a sense that the market is reaching an equilibrium as we head into September, late August. Looking at a couple of the indices that we like to track, the load board activity, in particular, dry van load to truck ratio dropped slightly to about 5.02 last week. Dry van load postings also dropped by about the same amount, by about 4%. So load posts this time of the year are still close to about double where they were in 2019. We're still at a 4-year high. But we think that the cooling off is a little bit of a reflection of the imbalance we've seen in recent weeks starting to stabilise. On the capacity side, there were about 1% fewer trucks searching for loads last week, so there's a little bit of easing in capacity and a reduction in the load post activity. On the reefer load board side, the load truck ratio for reefers decreased by about 6% last week to 8.31, back around 2017 levels, largely driven by a similar drop, about 6% in load postings. So compared to this time last year, year over year, we're still way up, 42% higher. But similar to the dry van sector, there's capacity easing, only a slight drop in load posts by about 1%. Over to flatbed, the load to truck ratio in flatbed, there was a continuation of a decreasing number of load postings last week. So we think that's a reflection of the market imbalance starting to stabilise. The reason we think that the flatbed market is cooling slightly, this is the 4th week in a row that load post volumes have dropped, which is kind of another example that we're seeing a cooling in this sector, in particular the lumber and building material sector. We're back around 2017-18 levels. with about 1% fewer trucks searching for loads last week. Over to the market condition index for dry vans, a couple of markets we want to focus on this week. We're still seeing a lot of activity and volatility on the southern border. The Laredo market's one that we watch closely. It's the largest truckload market. About 43% of all daily truck crossings occur in the Laredo market, and about 38% of all US trade. There's a big imbalance at the moment driven by the trade deficit. Inbound loads, which represent exports into the Laredo market, they're up about 40%, while outbound loads out of the Laredo market into the US for imports are down 25%. So this imbalance is causing carriers to increasingly not go to the southern border market because there's less volume coming out. It's driving up rates slightly. Capacity is tightening across those markets, especially around McAllen and Laredo. Out to the Midwest, the Denver market's still a strong backhaul market, but it did show some strength last week with volumes up 2%. In the upper Midwest area, particularly around the Great Lakes, the reasonably large market of Milwaukee is starting to pump out some serious volumes as we head into late August. Volumes are up 5% week over week and up about 30% month over month, with about 11% of those loads moving regionally around Joliet, Chicago, and Detroit. Rates are up about $2.42 a mile, $2.42 a mile out of that region, which is pretty strong for dry vans. Over to the refrigerated market condition index. The Buffalo market is one that comes online this time of the year. We don't often get to talk about upstate New York, but the summer produce season is hitting top gear. It's the number 2 cabbage producing state. Reefer volumes out of upstate New York are up about 30% week over week and about 108% month over month. Capacity is particularly tight in that region. Spot rates are up 12% week over week to $2.42 a mile. And that's about 20 cents a mile higher than the national average. Over on the Pacific Northwest and West Coast markets, you see a lot of activity there in the Pendleton, Twin Falls area. Really strong volumes coming out of Twin Falls. Volumes are up about 60% month over month. Most of those loads head to Seattle for export, but about 5% of the loads also head east to Miami and Atlanta. Today's USDA truck report shows that about 2,500 fewer truckloads were moved this week. So volumes are starting to decline. Produce volumes typically peak around mid-June, but for both imports and exports, they've been declining gradually since then. Over to the flatbed market condition index. Lumber building and construction still is dominating the market. There are some signs it's cooling though. The lumber producing states in the southeast of the country, that's where most of our flatbed volume comes from. They reported 12% week over week drop in volume. I think a lot of this has got to do with depleted inventories of building materials that have been stocked up in the various retail outlets. On the West Coast, Portland is showing really strong volumes. It's the leading flatbed lumber producing state. Volumes there are up about 24% month over month. And in the Midwest, the Terre Haute market, volumes are up significantly there by 81% week over week. Some recent data from the US Census Bureau shows that flatbed operators have got a bullish outlook, is how we describe it. Building permits are up about 19% in July, which is a really good indicator of future building activity. Wrapping up with the rate forecast and the year over year view. Dry van spot rates are sort of in unseasonal territory. They're up around $2.02 a mile, although a little bit of a sign that they're leveling off. They're still the highest we've had in 5 years for mid-August, and up about 25% year over year. We think the short-term outlook is that rates could be stabilising. Volumes certainly are stabilising as the market adjusts to the new norm. Time will tell how this plays out. Over to the refrigerated spot rate sector, reefer rates topped off last week about $2.20 a mile. They only moved up about a cent, but they're now 38 cents a mile higher than the same week in 2019. When capacity was much tighter in 2018, they're about 8% higher than that high watermark. Spot market volumes at the midpoint in August, they appear to reach the peak. Reefer load posts are starting to decline also. So again, I think there's a sense that the market has reached its peak, albeit a little bit later than usual. And wrapping up with the flatbed year-over-year spot rate review, flatbed spot rates ended last week at about $2.04 a mile. They're up 2 cents a mile week over week. They're about 10% higher year over year. Of course, the NOAA had predicted an above average hurricane season this particular year. So that's always a factor as we head into the fall for the flatbed carriers who haul a lot of material into those areas during rebuilding efforts. That's the wild card that we're watching this year, given the recent forecast. So that's our market update for supply and demand. Ned, over to you. What have you got in store for rates over the next 4 weeks?
Some exciting stuff, but before we do that, I'm really interested in what you were talking about building starts. One of the other people on the data science team was talking about how kind of unusual the building starts were this particular report, where there was a lot of multifamily and a lot of like big construction, whereas single family home construction was way down. Yeah. Do you think there's any implications for the flatbed market from that?
I think I would be cautious, even though new home starts are up about 23% in July. It's more of a rebound effect. So they're only up slightly year over year. So what you saw is this massive drop off in April, May, and then this rebound effect. So even though the volumes are up, and about 50% of that volume of new home starts is in the southeast, I think people need to be cautious that we're only just getting back to where we were this time last year. Why I'm a little bit optimistic about it is I think building permits are a really good proxy for future building activity, and because single family homes are the most freight intensive of all construction, I think flatbed carriers have got something to look forward to, particularly in the southeast.
Awesome. Thank you very much. With that, I think we're ready to move over to the forecast, so I can hopefully not shoot my mouth off this week, or fill my mouth with delicious hat. We're starting off by looking at the dry van forecast. So here you can see in the blue is the actual market rates observed by DAT. And then off on the right, you can see our forecast models. We have in red the short-term model, in green the Ratecast model, and in between our blended forecasts. So here there's a little bit more model convergence than there has been in the past couple of weeks. And for me, at least, that's kind of a positive sign. Generally, if the models agree, then it's more likely that they're all picking up on the same sort of a thing. Although the divergence here is that Ratecast is expecting only a little bit more up and to the right before it flattens out, signs of that plateau, whereas the short-term model is expecting the trend that has been continuing since April to keep continuing. And I see no reason to disabuse the short-term model of that particular viewpoint. Next, we're going to move to the reefer model suite. Again, the blue represents actual market rates observed by DAT, and then off to the right, you can see that the model convergence is very strong here, where all the models are in very close agreement for at least the first week and a half, 2 weeks, before there's a little bit more divergence as it goes out further, which is kind of unsurprising. But again, that short-term convergence is a real sign that things might be flattening out a little bit. More signs that plateau that we were talking about in the key points could be there. But the short-term model continues to expect that trend is going to keep trending. Finally, we're moving to the big divergent forecast that we have for flatbed. You can see again, blue are the actual market rates observed by DAT, and then off to the right are our model suite, with red being short-term, green being Ratecast, and here we only have the one blended forecast that I can see. And the short-term model is really expecting that trend to keep continuing, whereas Ratecast is expecting and is seeing signs of there being that plateau and maybe a slow slide down. That said, I feel like the short-term model has been really right this year so far, and I'm not willing to back a particular horse. A little gun shy about that. But speaking of being holding yourself to account, I think we have a really spicy Ask IQ question. The listener submitted question was, how do you know that Ratecast is 95% accurate? Do you have an answer that isn't going to involve me talking for 10 minutes trying to explain all the details?
I do. And this actually was a question that came directly from one of our customers. So it's a question I really appreciate too, because this is the question that if you're buying data and you're using an analytics product, you should be asking your vendors. And if your vendor is skittish about answering this or kind of gives you a nothing burger answer, my recommendation is that you should be concerned with that particular product. So all of that being said, and in kind of that vein, 95% accuracy is what we advertise because that's what we strive for. Based on our historical studies, we've been shown that, our models can hit consistently 95% accuracy, but full disclosure, when COVID was being COVID and 2020 was being 2020, we weren't 95% accurate. We saw that drift down to 92, 91%. from an aggregate level. But when things are sort of more normal and even keel, we've seen it up to 97.5% accurate. So
just to defend Ratecast briefly here, when you said 91, 92, that was for a period of about 3 weeks in the middle of April.
Absolutely. And I still think that given kind of a naive approach of just guessing, you'd be much better off at 92, 91% versus 15, 20% with guessing during that time period.
Oh, no, absolutely. I just want to defend the honor of my model here.
Yes. Thank you, Ned. So how do we do it? There's a key differentiator that we at DAT have versus some of the other folks doing price forecasting in the industry. So let's just level set on what that is. Ratecast predicts rate view, and rate view is actual rate submissions, $70 billion plus of annual rate submissions, paid freight bills. Some of the other forecasting models predict what a rate, and this is admittedly, right, what a rate should be. So based on these X number of factors, rates kind of should be this. So when they talk about accuracy, they're comparing prior iterations of that model versus more recent iterations. So what that model said rates should be 14 days ago to what that model said rates should be today. Whereas with DAT, and I'll talk more about this in a minute, we're comparing what we think rates are going to be based on the model and comparing it against what rates actually were on that date. So let's just put a pin in that for a second. There are two real issues with the former approach. First, it becomes kind of circular when you're really just predicting how well you're predicting things. Now, when you say it's precision versus accuracy, right?
That is the technical term there. If you go back to the archer analogy that I love to use for forecasting, if you have an archer that is consistently shooting 2 centimeters above the bullseye, that archer is very precise. They're always hitting that same mark, but that just because they're hitting the same mark doesn't mean that they're hitting the actual conditions, the actual accuracy. And so it's a good first step. Precision is a hell of a lot better than not having precision, but I would rather be accurate than precise.
Right, and so that leads us to our second fundamental, at least difference. I won't say issue. I don't want to imply that it's inferior. The second fundamental issue we have is that everything that happens in that modeling ecosystem is predicated upon how you believe what that rate should be in that relationship. Anytime we use a word called decoupling, but that's just a fancy way to say anytime rates behave abnormally, and in this industry we know that happens all the time, that fundamental assumption falls apart. And then accuracy or inaccuracy rather compounds, right? You have the effect of the decoupling or the fact of like rate abnormality compared with your standard model error. So again, I think these are just important caveats. I think having multiple modeling approaches is a sound strategy. But I think it's just important to point out that's a different modeling approach. So back to what we put a pin in. The beauty of Ratecast is that you, the customer, the viewer, can actually grade us, right? So if you log in today and you run a lane and you'll see the 8-day Ratecast. If you go ahead and write down what those 8 values were, and then log into RateView over the next 8 days for that lane and write down the 7-day RateView rate minus fuel, you'll actually be able to grade how well we did. If you take the differences in those values, and then if you have any negative values, just make them a positive. Take the absolute value because we want to make sure we're capturing misses high and low. And then you take the average. That'll give you our mean error. And that number is low. So data scientists and analysts like error. Marketing likes big numbers, so they like accuracy. So if you subtract 1, right, if our error is 5%, we can say that we're 95% accurate. But the last thing I'll talk about, and I'll turn it over to Ned to explain, is that we don't use mean for our user interface. We use median, and there's a pretty good reason why we do that. You want to touch on that, Ned?
Absolutely. So if you're doing the comparison of Ratecast to RateView, you want to make sure that you're comparing the same lane. So Ratecast sometimes has to scale up in geography compared to RateView because we require a certain amount of confidence in our model to be able to make those forecasts. We require a certain amount of data. So especially if you're searching for a lane that there's not a lot of traffic on, you want to make sure that the Ratecast rate that you're writing down is matching the RateView rate specifically on the specific geography of the lane rather than it being scaled up or scaled down for one or the other. But anyway, back to the question about determining why we're using the median rather than the mean. And the answer is mean is very subject to what we call in the business outliers. And those are kind of unusual events. So the typical way that this is explained is that if Bill Gates walks into a bar, the average person in the bar becomes a millionaire, and that average is the mean. The median doesn't change very much. And so the median is a reflection of, on average, when you use this product, what is going to be your outcome. And I feel like that is the most intuitive and most useful tool for somebody, so that we're not sandbagging ourselves by taking our ultra accurate predictions, or sandbagging ourselves by taking predictions where we weren't quite so accurate, and causing that to really make big shifts in those error bars that you're experiencing. Does that make sense, Ken?
Yeah, and these are all different approaches, and they were made, I think, with the right intent and logical. But again, just to kind of close this segment out, it's only right if it fits you and your business and your analysis that you're trying to complete. So
yes.
AskIQ@DAT.com is always available. The best way to walk through this is for you guys to send us a specific lane, and we'll show you historical accuracy performance. But that's really boring over video, even more boring than Ned and I talking about model error in sports and Bill Gates analogies. But feel free to reach out. We're happy to do it. We do it all the time. It's what we're here for. So we're starting to get long-winded at this point. I'm just going to wrap this up and say...
Can I just say one thing really fast before you wrap it up?
Sure.
If you are a RateView subscriber and a RateView contributor, you can see your performance against RateView. Because Ratecast is predicting RateView, one of the most important things to be able to use Ratecast well is understanding the relationship between your rates and RateView. So if you are a contributor, you can see in the historical RateView data how well you did relative to RateView, so that you can use that same adjustment or a more complex adjustment to get a sense of how well RateView reflects your lived reality.
That's a great point, Ned. Right? If you consistently hit 3% below RateView, and
congratulations.
That Ratecast is 3% off, just adjust it down the same amount, because the same fundamental calculation methodology is present. So again, all of that being said, I want to thank everyone for tuning in this week. We might not be here next week. It all depends. I need to go to the hardware store and try to buy a tool belt and a hacksaw and some other things.
You already have those, Ken.
Given Dean's market update. And all of that's a lie. I live in the Midwest. I have a fully stocked garage and toolbox. But again, thanks for tuning in. Thanks, Dean. Thanks, Ned. And we will talk to you, if not next week, the week after. Have a great week, everyone.
Bye.